Is there any good news in banking?
Well, I think the good news is it's hard to see it getting worse, to be honest. Apart from the question...
Can I describe half a dozen ways where it could?
Well, apart from the question of the oil exposures. I mean, that's where ABN, he just said, we're taking kind of middle of range 50 basis points charge. We know, for example, that reserve-based lending is, say, 10% of the European banks' exposure. It's in the tens of billions. And we know that the reserve-based lending, we know that they're going to, in the US, mark down their reserves because of the way the SEC accounts for this, the DEC basis. So there is almost certainly more bad news ahead for provisions. That's one thing that's discounted into price. Clearly, Sweden cutting rates, the ECB almost certainly cutting the deposit rate on March the 10th. Again, that piles more pressure on them. The banks today have done a fantastic job focusing on fee income growth, offsetting the net interest margin pressures. And if you look, the interest expense has fallen as much as the interest income has fallen. But from here, there is no revenue growth. It's very, very hard to see. And the switch into alternative savings, higher margin stuff, again, that's just become very competitive. It's really from here it gets tough. I don't disagree. I don't paint a rosy picture, but equally when I look at what's now discounted in share prices, and you've lost sort of 200+ billion from the sector in the first 6 weeks, the market is fully aware of these, and you've got some things trading on 0.4 times tangible. Arguably, capital's still a question as well, but the outlook isn't rosy, but there's a lot in share prices.
Yeah, so Bill, things could get worse, but a lot's already reflected in the share prices.
You know, we do disagree about a lot. A lot of it is factored. A lot of the reality about banks is known, but it's the fact I think we still have further contagion risks to come. We've got a ridiculous situation where banks are having to pay to deposit money with the ECB, and the result of that is they have to charge more to lend to their customers, which reduces the amount customers are borrowing in an already depressed Europe. And so I think you're going to see NPLs, which are already much higher than they should be and are going to get worse. We've got the potential shock coming in from market events. Now, I keep going on about these ridiculous weapons of financial mass destruction, the COCO or AT1 bonds. We are going to see something occur there in Italy. I think there's a good chance that we will see other COCO bonds kick in. That will generate a net wave of negativity. And at the end of the first quarter, we're going to see a lot of the holders of these bonds who wake up to the reality that they're no longer priced at par, but some of them all the way down into the 70s, and they have to sell them. So you get a wave of selling hitting the market, and that will contage and impact bank prices further. The question is this the time to step in and buy banks? No, it's not. Wait.
Can I just touch on the point you made there? I mean, when people bought these COCOs, it was all about distance to trigger. There is very little danger that any of these are going to be triggered. The point is now, is the coupon covered and will it be honoured? Clearly, as Deutsche Bank has proven the other day, their access to liquidity with the LCR, liquidity coverage ratios, and NSFR, massive liquidity. So I think short term I do not see a negative catalyst because we are nowhere near the triggers, so they're not going to be converted.
Jonathan, you'd said they've got the liquidity, the access to liquidity to make the coupon payments, but you would also say that the trigger, and this is the key thing that you think the Italians won't have, is that we won't go through these levels of buffers of capital.
They won't bail them in.
Italy is an entirely separate point because it all depends on what the SSM does.
Italian bank to trigger another wave of contagion. I agree with you. Deutsche Bank is very unlikely, tough to trigger. Unlikely tough to trigger it, but the fact is the prices are still going to fall because you'll see a wave of contagion from what has got to happen in Italy.
One of the problems with AT1s is it's a massively illiquid market. I mean, you ask any bond trader, you can only buy at issue because there's no point trying to buy otherwise because you move the market so materially. So the prices also, we know from the lack of liquidity, don't necessarily reflect fundamentals.
But then that takes us back, I know we've got to go, but does that take us back? That takes me back to collateralised debt obligations in which pricing was mismatched and were not honoured. It takes us back to that kind of paradigm, or is that overstating the case in terms of COCO and weapons of mass destruction?
The key thing with COCOs is, and the difference with CLOs is, you could understand the CLO, although it was extremely complex, you could understand it. The optionality that is embedded in COCOs about where the trigger levels and where they convert is very much more complex, almost impossible to hedge, and that's why it is a real concern that the people who hold these don't really know what they've got.